trend is more interesting than just beta, there's a lot of, especially the way we think about it, where there's sort of all these the markets are made up of cycles of different frequencies. And so if you're employing trend, really what you're trying to capture is the meat part of those cycles. And so there's some skill in understanding, should I be short-term? Should I be long-term? Should I be medium-term? Should I adjust that over time? Why do I adjust that over time? So it is definitely more interesting than just a very straightforward, here's the beta, anybody could do this.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kaastrup-Larsen.
Hey everyone, and welcome to another edition of Top Traders Unplugged, where Alan Dunn and I are joined today by Ryan O Grady, co-founder and CEO at Row Asset Management, as part of our mini-series focusing on the one investment strategy that beat everything else in 2022, namely trend following and managed futures more broadly. First off, Ryan, it is wonderful to have you on the podcast. Thank you so much for joining us today. We really have been looking forward to our conversation. How are you doing? Hope you had a good start to the new year.
Yeah, doing great. And thanks to you both for having me. Excited to be part of the podcast. I'm a fan of the podcast. So yeah, good start to the year, good end to the year, obviously. So yeah, and again, thanks for having me.
Absolutely. It's our pleasure. Now, before we dive into the different topics that we are going to discuss today, maybe just to set kind of the stage for the conversation, give a little bit of context to for the audience. Maybe you can just say a little bit about the the background of your firm, in particular, maybe the kind of strategies that you run and where the business kind of stands as we enter into 2023.
Sure. Yeah. So I'm a quant macro lifer, and that's actually true of all of the. Row originally was kind of a group of people that had worked together for quite some time. Like the Row stands for Ryan O Grady Weiser. My partner Jeff Weiser and I have worked together since 1995, and a lot of the core people at Row have been together as a team and as a group since that time. I started 1992, so the other people in the team started kind of around that time, and so. We've really been doing this our entire adult lives. And so Row started in 2010, and our goal when we started the firm was to create a true all-weather return profile that had the divergent characteristics that one would expect from a member, from a CTA. And we are a member of the SocGen CTA index, which I believe is the 20 largest managers who are open. And, so for us, it's always been about having a divergent strategy, having something that adapts, right? So that, we really only run one strategy, which all of our best ideas kind of flow into. And then we have sort of subsets off of that. But yeah, so the idea is it's sort of when you think of the spectrum of active to passive, where if your position is wrong, how do you react? Do you just let it ride? Do you add to it? Do you react by reducing it? And so we see ourselves as kind of the role that we fit within sort of the investment world is we're on the reactive side. So it's, the other side would be sort of equity beta or private equity, things like that, that'll hold positions for years, whereas we tend to react pretty quickly to changes in market environment. And so, that ends up looking like trend following. I think that's how we do correlate to trend followers. But yeah, so that's how we see ourselves. And then, as far as business goes, like we have great relationships with our clients. I think that's really what makes this fun is that, we created a return stream that we feel like is useful to people, and it has worked out to be useful to people. So we're very happy with how that interaction has gone.
Sure. No, absolutely. Now, we have created a long list of topics that we want to talk about. And so we will essentially go back and forth between Alan and I to dive into some of these. And as usual, Alan, maybe you can kick off the first topic for us.
Sure. Ryan, you touched on a few kind of features of your approach, with being all weather, having this divergent characteristic, being reactive, etc. If you were to describe the kind of investment philosophy which underpins your approach to markets, and the reason that you believe that this is a good way to approach investing, what would you say about that investment philosophy?
I think so. Beyond what I said, because trend following is an approach where you are reacting in a pro-cyclical way. If your position is working well, you are either keeping it or adding to it, and if it's working against you, you're reducing it. And so that is a feature that our products have. But there is we do have a philosophy where we are agnostic to style. So we don't need a model to be a trend following model for it to be useful to us. In fact, we do quite a bit of research on non-trend strategies. We feel like there's always a useful, it depends just on how much weight you want to put on the different strategies. But there's, no matter what the approach is, whether it's a carry approach, earning a yield on a position, whether that's sort of backwardation contango, or that's sort of an FX trade or an interest rate trade, or something in the long-term value arena, or short-term mean reversion, or there's any approach where a systematic, a set of systematic models is going to yield a durable output of profitable returns that you can depend on over time. I think we're gonna find a way to use that at some weight. And that's, the philosophy also is that we're continually trying to think about new ways to add models to our system that, to a certain extent, this is a constantly changing game. And so, I know we have some competitors who think of, they feel like, well, we've got something, it's worked for a very long time, and so this is the commitment we have to this approach, that we're going to stick with it. Whereas we're maybe a little different, where we feel like the markets are constantly changing, and so it's not so much that it's changing and ruining stuff that we've built. It's more it's changing and creating opportunities to come up with something new. So, so our approach is
Yeah, so not so much the case that you have a kind of a fundamental belief in any particular model, or a fundamental belief that trends will always be evident in markets and that'll be the way. It's more belief that there will be opportunities to capture via research, and that you can do that.
Yeah, that's exactly right.
Okay. And then in terms of the kind of investment objective, so you mentioned all weather. So you're aiming then for a strategy that's not just a diversifier. Again, some CTAs might come from the perspective of generating an uncorrelated return profile to equities. It sounds like your philosophy is you're aiming to generate positive returns regardless of the market environment. Is that fair to say?
Yeah, so that's definitely like our approach is not designed around a greater portfolio necessarily. It does work out that way, but the first investors in this program were Jeff and I, and so we designed it to make money. And actually, we've had interesting conversations with our clients where we talk about, we underperformed here, but whatever index did worse, and they even say to us, look, we really just count on you guys to make money. We'll certainly point out when our, when the return stream that we're throwing off sort of works in a portfolio in a particular way. But yeah, the core goal is that our performance stands on its own.
And just delving into like why there should be these opportunities in markets, why should a research process be able to unearth kind of inefficiencies or anomalies? Is it market microstructure, behavioral biases? What's your perspective on that?
I guess it's all of it, right? So this is a closed system of market participants, and There are some people who play, well or try to play well, and we sort of fit in that category of we are in this system. With system, I mean like the markets that we trade in, trying to earn a positive return. There are other people who are in this system for some other reason, for risk mitigation, and then there's just some people who there's behavioral biases, or the greed fear cycle, or then there's even people who run strategies where they're forced to do a trade that they may not want to do, like some sort of risk parity system that when vol goes up, they are forced to sell their positions, whether they believe that's a good idea or not. So that mix of participants, some of whom are, making, it's really about trying to make the most good decisions versus trying to avoid mistakes or avoid. So that's kind of on the active side, how someone who has a solid approach is able to succeed versus there's some participants out there who really are not interested in, they're not part of the market for profit. I mean, there's in the foreign exchange world, there are central banks who, have no interest in, profitable trading. Their interest is in smoothing, monetary policy or something like that for their country. And so sometimes they're doing things that they know are not necessarily profitable trades. They're doing them for some other reason. And so that's what creates opportunities for firms like us.
Yeah, no, I want to stay on some of these topics. You mentioned that you have kind of this all-weather approach, but you also mentioned trend following and so on and so forth. And it kind of reminds me of an article that Cliff Asness wrote a few months ago. I guess he was taking it from a standpoint of trend following, but he was essentially saying that many of those who were identifying themselves as trend followers a few years ago kind of changed along the way, adding more stuff to their strategies, maybe as a response to fewer trends for a period of time, but maybe also, and I wanted to hear your perspective of this, maybe also because we are all being influenced to some extent, and maybe therefore we're all becoming too concerned about our sharpe ratio, so to speak. What are your thoughts on that? Should we be concerned about our sharpe?
Okay, yeah. So that paper was forwarded to me by a few of our clients, actually, and they said, "What do you think of this?" Because they know that that Roe would kind of be the opposite side of what that paper was arguing. And so I guess the one difference between us and sort of the foil of that paper is that we've always been committed to having a multi-strategy approach. But the other thing about the paper was it kind of implied that managed futures CTA has a specific role, and that role is, and we don't necessarily agree with that the role of what we're doing, that's kind of up to the purchaser. Maybe they have a different idea of what it's supposed to do. So so that was part of it. I mean, I think the other part that when we think about what is trend following, and trend following is not long vol. I think then that's not necessarily what the paper was about. But I do think it's important to remember when you're putting together a portfolio of strategies and you feel like, well, I need to stay committed to trend because trend is long vol, and I need to be part of, or I need to throw off a long vol P&L. But trend following isn't long vol. In fact, if you look at the skew, the daily skew of a trend following strategy, it's negative, and that's true for a very long time. And it's because on huge shock days, usually trend followers have the wrong position initially, and then they eventually get to the right position. But really, what trend followers are is they're long low frequency vol and short high frequency vol. And they're also short liquidity. I mean, the trend followers require, if a trend follower could execute its entire strategy instantly for no cost, the profitability of the strategy would be much higher. So, so in those initial shock moments, when sort of going back to the paper, that's kind of, the implication of the paper is that this is why you're in the trend following space, is because you're worried about these things. It's not even necessarily a trend that performs the best in the first moment or the first day or the first week of those sorts of events. And so I think it's better, that's obviously our philosophy, that it's better to think of in more of a holistic, think of, well, there's low frequency vol, there's high frequency vol, and markets are cyclical. That if you think of, well, what is a trend following model? Like trend, if you believe the trend is the right model to use to replicate behavior that we see, then you would expect prices to reach infinity or zero with certainty eventually. And that isn't actually what happens. So, or at least, not to the extent that a true trend following data generating process would imply. So we think of there's long cycles where they're long enough that trend following approaches can exploit them. And then there are short cycles. And then, the nature of cyclicality leads to longer term or even shorter term value mean aversion type approaches. And then in between, you have the ability to hold things and get paid for them. So to us, if you limit yourself to trend following, given the way that we see how markets behave, I compared it to a haiku. You're sort of limiting yourself. You're saying, well, I'm going to exploit this part of how things work and not the rest of it.
Yeah, no, interesting. And also just staying on the paper a little bit, because I think Cliff introduced kind of this idea that trend following has a dual mandate. One was, I think, to make money, but also to make money in particular when equities were in a crisis. And I certainly remember when the term crisis alpha got introduced after the financial crisis. I thought it was great. I'm not so in the same camp anymore, because I think we just end in a debate about what is a crisis instead. But I know that you sit maybe a little bit outside of that. So maybe this is a question where you look in at the more pure trend followers in our space. But do you think that, I'm curious about what you think about maybe investors' expectation to what we as quote unquote, or maybe I shouldn't say we in this case, but trend followers, what investors should expect from a more pure trend following strategy, if we take a step aside from what you're doing specifically, because clearly trend is part of what you do.
Yeah, and I think from the point of view of investors, pure trend and what we're doing are pretty close, right? Like, it's sort of, you see the differences more when you're right down in it with another participant. But from the outside, I think, our correlation is pretty high to pure trend. And so, yeah, it is actually something you have to be careful about when you're talking to people, because you certainly don't want to make any promises or guarantees of how you're going to perform in an equity drawdown. I think the right way to think about it is to sort of work from the other direction, to say, okay, let's imagine a scenario where, this one's going to be kind of self-serving because it just happened, but let's imagine a scenario where both stocks and bonds go down 20%. What strategies could possibly make money in that environment? And so then, whether the trend followers of the CTA community do or don't, they could have, or it certainly created a window of opportunity for them. So when you're trying to put a portfolio together, certainly you did your job in including a divergent strategy, even if, sometimes the setup of it won't work out the way you would have hoped. Like, equities in the past 12 months have been pretty difficult, even though they were in a downtrend. If you look at the really strong performance of CTAs in the last 12 months, it had nothing to do with equity. It was all about sort of interest rate moves and commodity moves. But I think it's still correct to think of it more as let's imagine different scenarios, different possibilities, and just think about what would be the right, who could do well in those types of scenarios, and then who probably won't do very well, and then balance the approach that way.
Yeah, no, I think that makes a lot of sense, Ryan. And actually, what's interesting also is that even though on an industry basis, no doubt 2022 was an important year, was a great year, but it was also a year actually where there were a lot of dispersion in returns at the same time. So again, a little bit about how you implement your rules and risk management, so to speak. Speaking of that, Alan, maybe it's time to dive into one of your favorite topics.
Yes, research. I mean, Ryan, you touched on how you started off in the kind of early to mid 90s. You've been doing this ever since. And you've emphasized how your view is that there are opportunities to be extracted from research over time. Where do you get the inspiration for research? Is it academic papers? Is it just observing the markets? And then how do you go about, starting with an idea to bringing it into a possible trading model in the portfolio?
Yeah. So, I mean, there is definitely a connection to academia that's important. That, our research team is pretty small, and that's always been true for us. And, even at our prior, the firm that we were all at together previously, the research team was never more than 4 or 5 people. And the team here, same thing, 4 or 5 people doing work together. And so academic research becomes a force multiplier where if we're canvassing 100 or 200 papers a month, then those are you can jokingly say that those are unpaid assistants for us, or interns, or things like that. And then, but I think the strength, what I perceive it to be our strength, is on being able to read a paper and have some intuition about, okay, this person has figured something out versus, this is just sort of overfit nonsense. And I think there is kind of a balance where, we have interns come in, and one of the first things that we give them is like, here's, I fit the whole thing on like one piece of paper. It's like, here's some moving average crossovers, and here's like a really simple carry concept, and here's just a basic moving average, 2 standard deviations go the other way. And we give that to them, and within a week they've produced a return stream that is pretty compelling. Like, it's not bad. It would be kind of an average CTA when you put them all together. And so that's kind of the simple side of the spectrum. And then the super aggressive research, it would be like having a team of 100 people and all this AI technology and trying to create the perfect model. And so there's this and there are firms like that too. There's firms with really simple models. There's firms with incredibly complex and, approaches with huge research teams full of machine learning specialists and PhDs and things like that. And, we find ourselves very comfortably in the middle of that we do, the issue with the super complicated approaches is maybe the intuition isn't there. And our industry is where, there's not really statistical certainty on whether a model works or not until it's run for a pretty long time. And then when it's run for a pretty long time, there's not certainty that the conditions that led to its success are still apply. So, an example we give all the time is the GSCI roll trade, where there was an inefficiency in the market created by, a lot of passive money on a commodity index that if you had an AI program would have found it. And a lot of, people in the sort of the middle of that range I described found it and profited from it. And then the inefficiency was fixed and it went away. And so, that's where intuition would come in and say, they fixed it. It's not going to be that trade's not there anymore. And so we're going to stop trying to exploit it. I guess the struggle, the rigor of our approach is making sure we're in the right spot of we're doing as much work as we can do, but staying within the realm of that everything we're doing makes intuitive sense.
And then obviously, I mean, you're basically highlighting the ongoing challenge of doing research, I guess, and deciding what's going to be persistent over time. But so what does that look like in terms of when you have your system and then presumably go and as reassess lookbacks and things like that? What does it take to kind of make changes to the system? Is it as much is it significant deviations from in terms of performance with the new system relative to the old system, coupled with kind of some kind of intuitive assessment that it's the right thing to do? Or how do you think about that?
Hopefully, if we're adding a model, it's because we sort of pre-understood a weakness in so like, let's say we're just sitting around chatting and we're like, well, what if X, Y, and Z happens? How would our mix of models handle that scenario? and we realize, maybe not so well. And an example might be like crowding. Okay, let's say there's a lot of talk now that our industry is going to see an influx of capital over the next few years, because that's pretty standard for when there's a big run in the industry, that the inflow comes 12 to 24 months later. And so then it's like, well, how will that impact our strategies? Is there an obvious negative to that? And is there a model that, if that negative scenario presented itself, that this particular model would actually do really well in that spot? And so then if we all are in agreement, yeah, okay, this type of model would do well in that spot, then we start doing the sort of lit review and trying to develop that model before it actually becomes necessary or useful, and then sort of have it ready. So that would be kind of the best case scenario for how things get added to the portfolio. And then the worst case scenario, or sort of the other, would be we had a model that's core thesis was globalization, and it was pretty clear in 2016, 17 that trend was reversing. And so that would be now that had nothing to do with the model's performance. We didn't do like a T statistic or, this, that, or the p-value or any of those things to say this model should be turned off. It was just the thesis behind it didn't really match reality anymore. And so we turned it off.
Okay. And, in the whole research world, the big topic in the last number of years has been, machine learning, and that there's been great strides in what can be done from a kind of machine learning perspective. And, my sense is mixed success. Some managers seem to have done well with it, others less so. Is that something you've extensively used in your approach? And what do you think are the merits and pitfalls of incorporating machine learning?
I think, machine learning is obviously really, really good at certain things. We just haven't seen that it's good at this yet. And there's probably people out there who have figured out ways to use it. But I think the issue is your data set coming in is a constantly changing data set that is resistant to you solving it. So, you'll see this isn't quite machine learning, but let's say someone writes down a series of rules on a piece of paper and says, well, I'm going to manage $10 billion on this and make 10% a year. It's like, well, you expect the market to lose $1 billion a year to you with rules you wrote on a piece of paper. And they're not going to, that's not, the market will adapt. And so the market's constantly adapting. And that's where I think machine learning might struggle. That in all other maybe with the spam email is kind of the classic example of how machine learning has gotten better. And spam is kind of a good test for machine learning, because spammers are constantly trying to adapt themselves to avoid getting caught. So, but that is kind of the nature of financial markets. They're resistant to being exploited, and they adjust to you. And so, the GSCI roll trade, again, a machine learning model would have found that, but it doesn't know when it stopped working. It doesn't know it's not aware of how the adaptation happened. Linear regression is a machine learning technique, just a very simple one. And so I'm not going to say we don't use it at all, but we certainly don't use it to the extent where we have models that work and we don't understand why they work.
Okay. So, you touched on maybe the example of, the possible influx of capital into trend, and that might be a model for consideration. Anything else, in broad terms, what are the new areas for research that you're excited about? Is it alternative data sets, or is it just dynamic opportunities that might present themselves as markets evolve?
Well, I think, thinking about how, flows definitely affect markets. And so that will become more important if the number or the capital behind strategies like ours increases. So that is kind of a big topic for us right now. And you mentioned alternative data. We definitely, obviously, if you're an alternative data provider, you're knocking on every single door. So we get to see all these different things that people are collecting and doing. I think a lot of it doesn't apply to us, because it would be more for equity managers or long short equity, things like that, because we're trading big things The one source of alternative data that does, it's not really alternative, but just maybe new to us, would be some sort of statistics on what people are holding. But I wouldn't say we're big consumers of alternative data.
Okay. So kind of custody holdings, things like that, positioning and flows, that's kind of what you're getting at there.
Yeah. But even then, so it's tough because like the individual, large custodian type names want to sell that sort of data, which we find to be kind of not kosher or not cool, I guess. They're sort of profiting from what their customers are doing. So that sort of data we sort of shy away from. We don't. But regulatory agencies, if they're reporting data like that, then we're interested in that.
Yeah, just staying on that, just before I move on to I wanted to ask you a little bit about sort of different types of diversification. There are kind of two topics that often come up on the podcast. One is kind of the view about how many markets should you trade. But I'm also, because this is my understanding of what you've been talking about so far, is that the diversification across different types of models is also something you apply and find very valuable. So I'd love to maybe ask you to talk about what you think the difference is between these two types of diversification within a systematic strategy, but also specifically maybe in terms of, do you think there is kind of a limit in terms of how many markets you really need to focus on? Likewise, how many types of models you should focus on?
Yeah, so I mean, both have the same risk, which is, so let's do it with markets. That's easier to explain. So if, let's say you have 10 markets and your expected return or expected sharpe trading, let's just stick to trend following. So you have a trend following system, a very simple trend following system. You apply it to one market, you assume the sharpe of that is 0.2. If you could apply it to 9 uncorrelated markets, now your sharpe's 0.6, if those markets are really uncorrelated. And then as you move higher and higher and higher, you theoretically should be able to achieve a higher sharpe ratio, and you should theoretically benefit monotonically from adding markets. So the caveat to that and the risk to that is that as the number keeps going up, you're probably targeting a return, not necessarily sort of, so if you trade one market versus 100 markets, you're probably going to put more than 1/100th of your NAV on each market, because you'll say, well, I'm getting diversification. I still need to target a vol of whatever your target vol is. And so I actually have to trade 2x or 3x or 4x what I would have traded if I only trade one market. And now you've introduced the risk that your correlations are wrong on those different markets. And so this is true both in the, you can make the same exact claim about strategies that are supposed to be different. And so, within the markets, the number of markets, we feel like there's kind of a right number, and we're always thinking about what that number is. And to the extent that it can be expanded, we obviously would love for that to be true. One of the sort of markets in China that are not really open to non-Chinese speculators, or maybe they are, but the way to approach them are sort of unfavorable at the moment. Those, when you load them in, they look pretty interesting. Like they look like they could definitely add something. So there's always going to be an opportunity out there for adding markets. And then same thing with strategies. One of the things that you can look at for how to mix strategies and how to sort of try to give yourself some confidence or some assurance that you haven't made that over leveraging mistakes, so you sort of consider them at extremes, like what is the max position, long or short, these different strategies could get. And that's really where it matters in terms of making a big mistake, in terms of having strategies that you think are different that all of a sudden become similar. That only matters when huge things are happening. And so you can do a lot of scenario type analysis, both actual like sort of simulation and just thought scenarios of how models should react. But again, in both cases, I think there's, in theory, there should be nothing but benefit to adding, but in practice, there is sort of a backward bend at some point when you've added too many.
Yeah, and given your AUM now, how many markets do you actually trade? I don't know how.
It's I think it's 97.
Okay, so about 100 markets. Okay. Now I want to shift gear a little bit to something that became a big topic, at least in my little bubble last year. Maybe partly because suddenly these strategies got a lot of attention, and this time around some good attention because everything else was losing money. And so suddenly replication of these strategies became a thing. And we saw obviously one particular ETF do really well in terms of growth in AUM, which replicates the SocGen CTA index that you are a member of, and most of the people we're speaking to in this series are a member of. So I wanted to ask you a little bit about replication, maybe how it feels to be replicated, but also maybe more importantly, what you think of, because if you're familiar with the product, in this case, it's not a trend model. It's a linear regression of the data that SocGen delivers. To your point earlier about linear regression and its limitations, but I'd love for you to talk about how you just feel about replication. Don't really want to put my opinion into your thinking, but just how you feel about replication of these type of strategies. Obviously, you know the nitty-gritty of them, so you probably also have some thoughts about what the pros and cons might be if you want to try and replicate them using linear regression of sorts.
Yeah, so in fact, we have a program that replicates, it replicates whatever you put in.
Okay.
And but it does
Can it replicate medallion fund, Ryan? Because then I might be interested.
Well, not well. That's the thing. So it replicates out of a set of really simple toy models. So it says, okay, I've got this set of little models and very simple rules, and let me see if I can put together a mix of these different things to match the returns that I see. And for, it can get pretty close. For the more deterministic a strategy is, and the more sort of, especially if it's limited to the same sort of markets that, the biggest markets, then the closer it'll get. And so, that's reality. Going back to the project that we give our interns, they can produce a pretty okay return with and a series that would have done really well in 2022 with very little knowledge and understanding, and really just essentially fitting what other people have previously done. So that's our job, is to be better than that. So, we're obviously very aware of not just replications. It is kind of interesting to replicate a strategy that is, now granted, the CTA index is not pure trend, but trend is a strategy. So it doesn't need to be replicated. What it is fairly straightforward. So that would be the only thing that's maybe a little bit surprising, that someone would even want to attempt to replicate a strategy that is in itself rules-based and somewhat publicly rules-based. But yeah, we see that as a competitor. We have people that we talk to who, have hired managers like that, and that's what they want.
Okay, so and we've certainly seen that as you say, performance can certainly during periods of time be very similar, and maybe even sometimes higher than the index it's trying to replicate. So that's fine. But since you know so much about this field, what are the risks that you see these type of approaches present that investors may not see? Because they may just be focused on the headline saying, well, we can, by analyzing the data, essentially pretty much get the broad exposure that these managers have, and therefore we can do it at a lower fee. So that's a compelling narrative, frankly. I personally think that there must be a trade-off here. So there must be some risks in there, and I'm sure you have a much better view of those risks, what they may be. So I'd love to hear your thoughts about it, if you could.
Well, So when going back to our approach, that we think about how to be as anti-fragile as possible. So, so I guess the drawback to a formulaic strategy like that is it's not thinking in a forward way about what might impact it negatively and what sort of models could be added to the library that would mitigate those periods. And so really it's all about how you perform in periods when, let's just stick with trend following. So how do you perform when trend following is not performing well? And let's go back to the sort of spectrum of complexity of a system. So, people would ask, like, how, why do you think you've grown and other firms haven't grown when returns prior to 2020 were pretty mediocre in the entire space? And you make this analogy about a bear chasing a group of people, and it's like, well, I don't need to outrun the bear. I just need to outrun you. So having a sort of a mix of strategies that still maintains that sort of exposure that people are hoping to get from you, but not dependent on it, and always forward thinking, and always not just even about strategies, but also markets and then, various risk management techniques, where all we ever think about is, mitigating drawdowns. Because when, if crude goes to $200, every trend follower, assuming it doesn't go there in an instant, every trend follower will profit from that. So that's not the hard part. The hard part is, what if it just stays between 70 and 90 for the next 6 months to a year? How are you going to handle that? And so that's where somebody like us and somebody doing, whether it's a replication or just a strict, here's my rules, I'll even show them to you on a piece of paper, kind of low fee beta trend, that's the value proposition there. Is like, who's managing the sort of off periods better.
Yeah, no, good point. Speaking about managing the off points, Alan, do you want to dive into some risk management?
Yeah, so you talked about managing the drawdown, which I guess there's a couple of aspects. Obviously, if we were talking to maybe a trend follower who then moved into multi-strat, I suppose that's been the journey for some people, that they started off with trend and then they wanted to mitigate those drawdowns and they added other strategies. It sounds like your journey's been slightly different, driven by a philosophy of being multi-strat from the start. So I guess the drawdown will hit when everything is kind of struggling at the same time. So what's your approach to dealing with that? Is it deleveraging in the first instance, or is it just sitting through it, or how do you think about that?
Well, there is, so there are, like, we'll get asked, there's like drawdown management, sort of, where as you lose money, you reduce risk, and as you come out of the drawdown, you sort of put risk back on. So that we're not believers in that specifically. I think where we're trying to combat, when we think about managing drawdowns, we're thinking about having a mix of models that we feel like should respond well. And if you look at our performance during our drawdowns, it does tend to be sort of, less volatile, and that's just a function of the approach. And so, but yeah, one of the things that obviously we spent being systematic, we're gonna look at anything that is potentially a systematic value add to what we're doing. And so you look at these setups where, if you go down one standard deviation, you cut to this, and you have this whole sort of rules-based setup of how you change you sort of top-down change your risk based on where you are versus your high watermark. And what's interesting, and you try these for yourself, and maybe you already have, it doesn't work. You actually end up getting trapped in these sort of death spirals where you keep cutting, and then your performance is good, but you don't make as much as you would have. But then you put money back on because you've come out of the drawdown, and then you go back into another drawdown, you cut risk again, and so you get stuck and you can't get out because of the way the system. And so I've had colleagues that we've talked to that they ended up down more than they would have been if they had no drawdown management. So so that's part of it, and the other part is we have no idea how we fit into someone else's portfolio. So like I think it would be off-putting if we were doing stuff like that when that might change how we're balancing something else that someone's got in their portfolio because of just our personal cuts based on drawdown.
You mentioned that you're kind of obviously multi-strat, but then present in terms of return profile very similar to trend following, and you're part of the index, etc. So is that just a function of the risk allocations, and that although it's multi-strat, that the trend following does tend to dominate either the risk allocations, or why is that?
Well, so I mean, trend is it's the presence of trend and the weight that it has, first of all. But even within, so like let's say you're in a carry position, and carry, you're not necessarily paying attention to direction. The whole point is it's a yield, but certainly if you have a reactive philosophy, then if volatility goes up, you will cut the position. And so now you've taken on a trend-ish concept. And so like we've noticed that our carry, not just actually ours, but in general, carry tends to have a positive correlation to trend, because when it's working, it tends to be left alone versus when it's struggling, then reactive strategies will reduce certainly the notional value. And so then it will sort of pick up a correlation to trend in that way. And yeah, I mean, in general, when you're reactive, when that's your philosophy, then you will always have a correlation to trend, since trend is a reactive strategy.
Okay, and in terms of managing the risk in the portfolio, I mean, what as you said, it's multi-strat, so you have trends, you've got carry type strategies, and I think you mentioned kind of value short-term strategies. Presumably, then at times everything will line up, and you will have higher exposure. So is kind of managing gross exposure the philosophy, or is that kind of alongside a vol target? Or maybe give us a sense on how you think about the particular metrics you're looking at.
Yeah, well, there's definitely just as a fail-safe, there is a pyramid of various concentration and limit checks. So you're just trying to make sure you're not over-concentrated anywhere. So, because we'll get like, what if all your strategies say the same thing? So they actually can't, because I mean, you can have situations for sure where let's say two of them are similar. Like trend and carry certainly will spend periods of time being similar to each other. But the whole point of mean reversion is going back to the cyclical way of thinking that so like think of a sine wave. It starts to move, your trend is profiting from it, then as it approaches the sort of upper bound of where it's going to go, that's where you would hope your sort of value and mean reversion would start to lean against it. So because the pure trend approach, one of its drawbacks is it tends to have its largest position when the trend is about to end. And so by thinking of markets more cyclically than in trend, that's where you can design your combination of systems so that in fact you've started to reduce as the cycle starts to sort of exhaust itself. But certainly we spend a considerable amount of time thinking about and checking and have systems in place to sort of make sure there isn't overconcentration.
And that kind of idea of not getting too large at that point when the trend might reverse, but is kind of a choice in a sense that at the same time, some of the big months in trend following is when you get the big position on and the trend extends. So is that just a choice to try and deliver more consistency of performance as opposed to have that really convex return profile? Or is it just do you think it's just a better way to run a portfolio over the long term?
Well, that's like, so there are people who it's pedal to the metal, and if something's going, they're not getting off that until they're told that they're wrong and it's going to be full. And so it's not necessarily true that we will not have that. If we are prematurely reducing positions due to a mean reversion model, that means that model's losing money. And so we keep track of how our different models are doing. That is different than us. And so actually, like when there are people out there who that's their philosophy, and you can make an argument that there's a place for both of us, like that philosophy might be useful. If you're only allocating, let's say, 1% to the space, maybe that sort of concept is preferable. So I think, yeah, we're aware of that approach, and it has its merits, but for us, it doesn't quite fit with what we're doing.
Yeah, you mentioned something earlier, Ryan, where you said people might ask, why have you grown during a decade where the industry has basically stayed without growth, if we take away the performance growth we've seen in 2022, maybe to some extent in 2021. And it also kind of brings me back to, I think, what happened after the great financial crisis. You also alluded to that after these periods of time, like 2008, maybe 2022, we may see an inflow of money to the industry with a lag of 12, 24 months. Now, how do you think we as participants, we as managers in this industry, how should we deal with capacity in general? And I guess one of the things that I wanted to explore a little bit more, which maybe we haven't done in the other conversations, is this balance between those who have essentially structured their, at least their trend following strategies as relatively low fee, maybe even management fee only, and where you could say that the only way for them from a profitability point of view to make a big impact, that is just to take in money from clients. Whereas other firms where they focus perhaps more on the performance fee, they might be much more sensitive to the point about capacity. Where does it start to hurt performance? I'd love to hear your thoughts about this, both as a manager, but maybe also as an industry, because I think we got a little bit of a bad rap last time from 2008, and to some extent people, rightly or wrongly, perhaps blamed it on some issue with overextension of capacity, even though I don't really think that was the reason. But at some point, strategies do hit capacity. So how do you think about that?
Yeah. So, I mean, just a general statement about fees. I think people charge as much as they can. So if a strategy is simple, then the fee is probably low because that's what the market will bear. And so it really just comes down to what's the, where does it fit in the, like, what is a strategy worth to somebody? And, performance fees in general, that's been, considered favorable in our industry because it creates the alignment of interests, that the manager is on the same side as the client and not, a management fee only structure. While that might be, in a gangbuster year, then you feel proud that you hired somebody with a management fee only because you didn't have to pay that big performance fee. But on the other hand, there's more that tends to be, and I think this is kind of what you were hinting at, it's more of an asset gathering exercise. And then, to the next point about, if there is an influx of money into the industry, and how will that affect things, and did it affect things? Well, I mean, what's interesting about 2007 and 2008, the money wasn't there yet in our space. So, those moves had nothing to do really with what our industry was doing. And so then the money came afterwards. Or, I mean, obviously there was money in our industry, but like the inflow didn't create the disruption. The disruption created the inflow. And, when thinking about it going forward, I come back to this again, that if assets make large moves, then we'll be fine. If we see another bout of inflation like we did in the first 4 months of this year, where that will be universally good for whether there's the amount of money we have now in the industry or double, those trends were pretty much unmissable. The whipsaws, the liquidity, how do you handle? So if you're wrong and you decide you want to get out, and there's a lot more money doing something similar to you than there used to be, then the price you're going to get is going to be worse than before that money was there. So if you don't change anything about the way you're interacting with the market and more money comes in, then where crowding will hurt will be when trend's not working. That the return, like maybe, in the old days, trend following either made 20% or broke even. And then in the, newer times, as more and more money came in, trend following either does well or loses, a fair bit. And that loss is a function of those whipsaws hitting harder because there's more money chasing or on that idea. And so then this goes back to what I was saying. It comes down to, can we do something to counteract that? Is there a way to adjust? And that adjustment would be in some sort of non-trend model to account for the loss that's going to take place. So those would be the biggest risks of not so much markets don't move in excessive ways because of CTA flows. Like that's just, they move because of something happening in the world, right? So that's where I think those will be
yeah. Let me try and then summarize it a little bit, and ask it in a slightly different way also, and that is, do you believe? Let's just call it that. The official CTA industry is now at maybe 400 billion. Do you think that there is a limit to how much money in the official CTA industry? Because obviously, I'm sure there are lots of people doing trend following that we don't see. But at the same time, if we think about this, if we see a large amount of growth into our industry, does it actually force managers to kind of revisit a little bit the way they do things, so to speak? Meaning, as you rightly point out, if we all do things more or less the same, then there could be a lot more crowding at the turning points or whenever we identify the trends to have come to an end. And does that actually, you as a manager, does that give you ground to think about, well, hang on, if the industry goes from 400 to 600, maybe we need to think about how we get out of markets and so on and so forth. I'm just thinking out loud here, but what are your thoughts on this, Ryan? Yeah,
well, definitely, and we do, and you definitely that definitely should be thought about. I mean, another thing, again, it's sort of a closed system of participants. It, hopefully, if the sort of CTA balance is growing, maybe the sort of the other players in the game are also growing. And so, it's possible that we could grow, but the whole market could grow, which it has. I mean, if you look at statistics of open interest over time, the commodities markets have grown tremendously over the last 20 or 30 years. So, that would be kind of the flip side, is hopefully there's room for that extra, the extra money on the strategies. But, let's say that people don't adapt, everyone just kind of keeps doing the same thing they're doing. Then what you would believe would be that the strategy should just become a little bit less profitable, that it wouldn't go to I mean, actually, it's sort of an interesting analogy that there was a poker boom in the mid 2000s from, the whole cards being televised in the World Series of Poker and things like that. And so there was a flood of new people playing poker. And then there were some people who were really good at it and they were performing really, really well. And then as time went by, the sort of participant pool started to shrink, but the pros were still there. And so now they were competing. So for them, it was different. It wasn't that they were growing, it's that their pool was shrinking, but sort of same scenario where the percent of participants who are profit seekers was going up. So it didn't drive them away, but it made it, it just changed things to be a little bit more difficult. And then the best players had to adapt. And actually, probably what really came from that is that you started to differentiate from the kind of good players and the really, really good players, because the really good players could actually exploit the kind of good players and the bad players. So, what could happen is it would put more pressure on the sort of overly simplistic approaches and actually sort of then the sort of differential between the good and the just okay would grow.
Yeah, no, I think that's a great point, Ryan. And actually, also, I'm kind of, while you're speaking there, I'm kind of reminding myself that when I started in this industry, there were less than $10 billion in total. And even back then, people were talking about, well, there's too much money coming into trend following. And yet here we are. And I think that it's the adaptability and just the smart minds that are in this industry that find a way to deal with that, which of course would be a positive problem. But let's see if investors, as you rightly say, will be smart enough to detect that some types of strategies might actually suffer compared to others, depending on quote unquote their level of sophistication. Alan, why don't you go through your last round of questions, and then I'll wrap up with a few more.
Yeah, I mean, I suppose just shifting over to the perspective on the role of the strategies you run more of in a multi-asset portfolio, and you talked about kind of your engagement with clients. We've kind of touched on this a little bit. I mean, obviously it being, but maybe it's slightly different in your case. If you're running a pure trend model, it's very much positioned as a diversifier, as something different to what maybe a typical pension fund or endowment holds in their portfolio. By running a multi-strat, are you in any way giving them some exposures that they might already have or not? Or how do you think about that? And is the kind of strategy, the portfolios you run, do they fulfill the same role, or is it just kind of an absolute return allocation in the context of a multi-asset portfolio?
Yeah, well, I mean, I'd say the first, it's sort of this fascinating reality that everybody knows that if you just do a stock bond cash and you throw the CTA index in there, that it's going to make the ratios look much better. Like, there's almost no point in even having that in a presentation because everyone agrees on it. And yet the allocation to strategies like ours is, way less than what these types of models would indicate. So then the question is like, why is that? And so one reason is, maybe these ratios are not necessarily what people are focused on, that they're focused on a return goal. And so it doesn't really matter that much. I mean, actually what's interesting, like we've spoken to family offices and it's like, do you make 20%? Well, no. That's our goal every year. Every year we need to, and they don't mind if they lose 40% because they just figure it'll come back eventually, and they're not really thinking about. They don't really have vol targets. So, I mean, that would be the first question: is if to the extent that you have a target vol that you're saying this is how much risk I want to take, and what strategy should I employ to feel best about the return that I can achieve, then that's where having something like us, any member of the CTA index would be beneficial to a portfolio like that. And so that's always the starting point, is there's a self-selection of there's some people who do think that way and some people who don't. And the ones who do are the ones that sort of come around and look, they're going to be looking at all the managers like us. But then there is questions specifically, for us, people say, well, I'm worried that your strategy XYZ might be similar to what we're doing in equity or something like that, because isn't that a risk-on strategy? And so why are we adding a risk-on strategy to our book of risk-on strategies? And so that's where, we can get into great detail and just see if that's true or not. And it turns out to often not be true, just because we're just in a completely different space. And I mean, like, just commodity carry, even if you just looked at a ticker on Bloomberg, the sort of the most basic commodity carry system that's sort of long, backward, and short contango, that's not a risk on necessarily, like that's not a strategy that has a correlation to equity beta at all. And in fact, if anything, it's got really strong inflation properties, and it just, it had a really great year in 2022. So, because when you have shortages, that's typically a scenario where prices are going to be rising. And so backwardation is going to be long and prices are moving higher. So, yeah, I mean, it just comes to the extent people, potential clients for us or for anybody else are willing to really drill down and see, because you can always start with the numbers, right? Anybody is probably willing to give you at least monthly numbers, and you can load them in and see, okay, this makes ratios better, and then that you can have the added level of comfort of trying to drill down and see kind of what the strategies are individually and how they match off. But like, I think, our goal and the goal probably of everyone in our space is just to try to get through that first step of, okay, there's so many managers. I think that's also probably the hard part is like, who do I pick? I feel like I picked XYZ manager and then they had a really bad year and I wish I would have picked this other one. And then, so just forget it. I'm just not interested anymore. And so like just trying to work through that.
That's what the replicators say, Ryan. That's exactly their pitch you gave there. So we have to be careful with that. Now, I have a couple of questions left. One that, just curious about it. If there's like one thing that you hear people say about trend following that you really disagree with, is there a thing that you come across where you say, yeah, no, I definitely don't agree with that?
Well, so there's a question of like trend beta, and it's like, is there a trend? And so I think what's kind of neat about trend is that there is obviously no individual beta, and the proof of that is people who claim to be pure trend following have really different returns, like way more different than like if 5 different firms have an S&P index fund, those performances are very similar to each other. But 5 different firms could say we are pure trend and they have totally different performances. And I think really it's that there's trend basis, that there's an exhaustive number of sort of strategies that, in a theoretical sense, that any trend follower could be represented by some set of those functions. And so, and then that can be kind of interesting for, like, let's say someone is they just want pure trend. I think it could be a really fun exercise for them to sort of canvas that basis and try to construct the strategy that fits best for them. It's not something that we do, but and then when you're evaluating how did a trend follower do, you can sort of, this goes back to the fitting question. You can find the mix of those things that kind of most closely, the sort of nearest neighbor to that return stream, and then see, did they outperform it? And that's where the skill comes in. So, trend is more interesting than just beta, there's a lot of, especially the way we think about it, where there's sort of all these the markets are made up of cycles of different frequencies. And so if you're employing trend, really what you're trying to capture is the meat part of those cycles. And so there's some skill in understanding, should I be short-term? Should I be long-term? Should I be medium-term? Should I adjust that over time? Why do I adjust that over time? So it is definitely more interesting than just a very straightforward, here's the beta, anybody could do this.
Yeah, no, I completely agree. Final question is just whether there's anything in particular you're most excited about as we head into 2023 or concerned about. Could be anything.
I guess, it's hard to say our 2 best quarters are quarters where bad things happen. So like, it's hard to, but that's just the nature of what we're doing. And when I say we, it's the whole space, right? So, so if you're like, well, what are the compelling reasons to be in our space? It would be, the argument that people made from 2010 through 2019 is, oh, well, the central banks controlled everything, so nothing could move. And that's definitely true for equities. Like, that created a difficulty for trend following in equities. And actually, the sort of fascinating response to that is a lot of the sort of bigger names adapted by becoming much, much longer term, because it meant that they were long a lot. And so that adaptation ended up being disadvantageous in 2020. So that's where you do have to be careful about sort of adjusting based entirely on past performance. So when we look at, okay, it's easy to say that the Fed, or not just Fed, central bank control is probably going to be less than it was less over the next decade than it was over the past decade, that their ability to control things should go down, because it's more of a political statement that as you're seeing more and more populist governments, that sort of the old school approach of just kind of let the Fed do whatever they want and give them unlimited resources to do so. It's, if anything, it's more likely to not be true than it is to be exactly the same. So that would be kind of the start. And then this was actually mentioned in one of your previous podcasts, just the rise of sort of competition, nationalism, protectionism, inflation, versus a decade of globalization. So when you have globalization, everyone's cooperating. So why would crude go from 20 to 80 to 20, back again in a period when everyone is sort of playing nice together? And so if you think in 2014, the reason crude moved so much was because countries were not playing nice with each other. That one group of countries was trying to put another country out of business by jamming the price of oil lower. So, and that was a fantastic trade for everyone in our space. So, to the extent that those forces continue to grow, this one of the big, COVID was obviously a huge contributor to volatility. But the Russian invasion of Ukraine was a huge contributor to volatility, especially energy volatility. So those types of events that are generally favorable to adaptive strategies, to strategies that don't have a bias, that don't have a benchmark, that react to things and sort of lock onto them and stick with them. And so to the extent that it seems like that should be, and so it's tricky because people come and say, well, did I miss it? And it's like, well, try to think 10 years. Like if that's kind of, it's a really tough thing where if you try to think of trend following as something that you missed or that you get in and you get out based on a view, that is a very difficult way to manage it because you're just always wrong-footed. And so to the extent that people have the more sort of steady state approach, we've seen, profit taking, which is great. And then when, and opportunities will come up in the future where maybe, traditional assets will do well. And then you start to see that flowing back. Like that's the right way to play it. But anyway, I'm sort of going off topic there.
No, it was actually, it was great. And actually it's super to hear kind of a different explanation to some of the things we talk about. So I really do appreciate that. And it's actually an excellent note to wrap up this fascinating conversation, Ryan. Thank you so much for being on the podcast and for sharing your thoughts and insights with us. We hope we can do this again sometime in the future. And to all of you listening today, I hope that you were able to take something from today's conversation onto your own investment journey. And if you did, please share these episodes with your friends and colleagues. From Alan and me, thanks so much for listening. We look forward to being back with you on the next episode of Top Traders Unplugged as we continue our deep dive into the CTA industry. And in the meantime, go check out the show notes for this episode and all the other resources you can find at the website. And not least, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.